the stock market corrects and falls due to rising unemployment rate, I believe this is a good opportunity to increase your exposure by buying stocks with strong fundamentals and future prospects to increase your expected returns.
Nice to meet you, dear viewer of the Eldorado YouTube channel. This is stock investment expert Byung-Hyun. The fastest reflecting indicators of economic trends are the ISM non-manufacturing PMI and unemployment. Recently, the ISM non-manufacturing PMI has fallen below. Recently, the ISM non-manufacturing PMI has fallen below 50, showing signs of Recently, the ISM non-manufacturing PMI has fallen below 50, showing signs of slowdown, and the unemployment rate is also showing signs of an uptick. Today, I'm going to talk about what these two indicators have done in the past and what it means for the stock and bond markets going forward. Today, I'm going to talk about these two indicators have done in the past and what have mean for the stock and bond market going forward.
ISM non-manufacturing PMI. The ISM non-manufacturing PMI is a key indicator for assessing economic trends in the service industry. A reading above 50 indicates expansion, while a reading below 50 indicates contraction. The ISM manufacturing PMI is typically used to determine economic expansion and contraction. This is because, due to the nature of the service industry, it rarely falls below 50. Unlike manufacturing, the service industry doesn't require massive investment in production facility, making it less sensitive to economic trends. Therefore, falling below 50 is extremely rare, indicating a severe economic downturn. However, the ISM non-manufacturing PMI recently fell below 50, signaling the beginning of an economic slowdown. While many have known that the ISM non-manufacturing PMI is deteriorating, the lack of stock market decline. Despite this suggests many have questioned the reliability of the indicator. This is likely due to the fact that the US economy has shifted from manufacturing to services, with the manufacturing sector decline and the service sector growing significantly. However, most key industries are in the manufacturing sector, and the slowdown in the manufacturing sector was expected to ultimately lead to a slowdown in the service sector. Therefore, while the manufacturing sector has already slowed, the services sector has maintained an expansionary pace and is now entering a slowdown phase. However, whether this drop below 50 is temporary or a continued contraction will depend on continued monitoring of future economic data. The chart you're currently viewing is a chart of relationship between the ISM non-manufacturing PMI and the US S&P 500 market. The blue line is the S&P 500 chart, and the orange line is the ISM non-manufacturing PMI. You can see that when the ISM non-manufacturing PMI declines, the stock market tends to decline. And when the ISM non-manufacturing PMIs rise, the stock market tends to rise. In 2001, the stock market declines as the ISM non-manufacturing PMI declined. In 2008, the stock market also declined as the ISM non-manufacturing PMI declined. In 2020, the stock market also declined as the ISM non-manufacturing PMI declined. Currently, the ISM non-manufacturing PMI is showing a downward trend. If the ISM non-manufacturing PMI falls sharply below 50, a significant decline in the stock market could occur. So it's important to prepare for this by investing in bonds. Unemployment rate. The unemployment rate measures the percentage of unemployed workers in the US who have been laid off. Late last year, the unemployment rate soared from 4.2% to 4.3%, fueling fears of a recession. This led to a decline in the 10-year Treasury yield to 3.6%. Subsequently, as the unemployment rate declined, stock market investors shift their attention from the possibility of a recession to inflation or stagflation. This caused bond yield to rise again and bond price to fall, leading to significant losses for bond investors, including myself. However, I anticipate that the unemployment rate will rise again as the probability of a recession rise again. At the same time, deteriorating employment and retail sales data will significantly weaken the upward momentum of the stock market. Currently, stock market investors are focused on inflation, and fears of rising prices have been driving up long-term bond yields. However, as investors shift their focus on inflation to job market, I believe bond yields will decline and the bond market will begin to attract attention. The chart you are viewing now shows the relationship between the unemployment rate and the US S&P 500 market. The blue chart is the S&P 500 and the orange chart is the unemployment rate. We know that the stock market tends to rise when the unemployment rate falls and fall when the unemployment rate rises. In 2001, the stock market fell as the unemployment rate rose. In 2008, the stock market also fell as the unemployment rate rose. In 2020, the stock market also fell as the unemployment rate rose. Currently, the unemployment rate is showing signs of rising. If the stock market corrects and falls due to rising unemployment rate, I believe this is a good opportunity to increase your exposure by buying stocks with strong fundamentals and future prospects to increase your expected returns. I will discuss stocks at the end of the month. Today, I shared my personal views on the stock market and bond market based on the ISM non-manufacturing PMI and the unemployment rate. Since this is my personal opinion, there is a high possibility that I am wrong. Please leave your comments and I will humbly accept and review them.